On board Parag Sancheti and continue corporate conversations. He's CEO at Rubicon Research, joining us this morning. Parag, great having you. When I'm looking at your Q4 numbers, they're an outstanding set of numbers. Your FY26 numbers also are very, very strong. Rupee tailwind is obviously aiding the numbers. Parag, you've got 90+%, 95% plus of your sales coming in from the US. Talk to us about how much of these numbers was rupee tailwind and how much of it is volume, new product, and the like. Just give us a sense of that first.
So thanks, Harsh, for having me on the show.
Great having
Rupee has been a factor, but I think the important thing is the business has grown. The revenue, as I mentioned in my last quarter, also revenue has seen a strong traction, and which continues to have a very strong traction going ahead also. So if you look at from a dollar to dollar basis, also we've grown 35%. And if you look only in rupee to rupee, it is more than 40%. If you look at the EBITDA year on year, we are up 67%, PAT 111%. So across board, as you know, the business has done well, and we continue to see strong traction for our products in the US market.
You did 12 product launches in FY26. You're expected to do far more in FY27. Talk to us about the product pipeline. Talk to us about how quickly it ramps up once the approvals start to come through for you.
Yeah, so Harsh, the product, we have a very healthy product pipeline. Yearly, we disclose the pipeline once. We put out that we have 24 products which are under various stages of approval with the FDA. So there is a strong pipeline which is there. In terms of the market share, we are very, very careful about how we take market share. It's not that we get an approval and we are looking to get market share. We are very careful because our focus is always profitability plus first, and then looking at market share. So whenever we pick a product, we ensure that we steadily grow the market depending on the market situation, ensuring that we remain profitable. And also, if you just see the commercialization rate we have, 92%, it's the highest in the industry, which means out of the 10 products we get approved, 100 products we get approved, 92 of them we are launching. Some of them could be just timing mismatch, but that's a very, very high rate of return on the R&D.
And Parag, give us some color again with regard to growth. You've probably done 25 to 30% X Forex last year for the full year FY26, right? Talk to us about old products versus new. And the new launches, do they ramp up, say, in FY27? Do the new launches of FY26 actually ramp up in FY27? What's the trend we can expect?
So if you see in the current growth, we have seen equal contribution of both established products or products which have been in the historical portfolio and even new launches. And we continue to see strong demand for our established products also. So the same ratio would continue going ahead. We've seen higher demand across our portfolio. So not only the products which got launched this year would ramp up in the next year, but even the products which have been approved 3 years back are also continue to ramp up. As I said, our approach towards market share is very, very systematic. So we do not go for crazy market share as soon as we get an approval. So continuing that approach, we would say the contribution of new launches during the previous and the earlier launches are going to be contributing equally across the revenue growth.
Gross margins, though, Parag, again, X Forex have come off. And based on your commentary, you seem to be suggesting that that's partly because you're relying on outsourcing as well, given the ramp up is still, especially in Pithampur, is only expected to happen in calendar year 27. Give us a sense, is gross margins the right way to look at this, or is the outsourcing piece giving you a higher ROC, ROE? Is that the better way to look at this? Contextualize this for us, please.
Yeah, so I'll just give you, Harsh, the philosophy how we operate, right? So I think for us, sales is very, very important. Sales loss cannot happen. So we ensure that if we have very high demand, and which I mentioned in last quarter and this quarter, we are experiencing extremely high demand for our products. What we would do is we will service those customers through outsourced manufacturing so that we don't lose sales. Now, philosophically, as a company, we are, Harsh, very clear that we will be always lagging in capex. In the sense, we will first create the demand and build our own facilities or capex once we have seen sustainable demand. And that's the reason we acquired Pithampur from Alchem last year. When we had seen sustained demand, we thought, this facility could be a good value addition for us. So if you look at, that at least in the next few quarters, you will see that the gross margin might be a little bit, there will be some misses in that. But as Pithampur comes online, we definitely feel that we'll be back to the same GM trajectory. But having said that, the important thing is we are still maintaining the EBITDA guidance at 22 to 23%. So no matter what our gross margins are here, our EBITDA margins still remain in the 22 to 23%, and we are pretty confident about that.
And how do you do that, Parag? So gross margins, how much do they come off by in coming quarters before the Pithampur ramp up? After the Pithampur ramp up, how much tailwind do you get? And what happens to EBITDA margins? Give us that picture.
So I wouldn't want to specifically comment on it, because I think as we ramp up, Pithampur is still, we've done all the activities and now we are waiting for the FDA inspection to happen. So I don't think I want to specifically put a number, but definitely the gross margins will improve from there. But having said that, from an EBITDA perspective, so the way we are, we do our working, or way we focus, I think we ensure that there is enough so that we are able to continue to keep the EBITDA margin at 22 to 23%.
Okay, so you'll calibrate it to ensure that EBITDA margin, at an EBITDA margin level, you keep it 22 to 23
we'll
regardless.
do all the steps which are required to ensure that it remains at 22 to 23%.
Understood. The other big piece, Parag, is the spend on R&D, which is roughly 10 to 11% currently. As you ramp up, and the growth is extremely strong, right? I mean, 43% Q4, 35% FY26. On this higher base, do you keep or you maintain that kind of R&D spend?
Yeah, so just to give you history, Harsh, Rubicon has originated of R&D, right? Rubicon is a science-first company. Unlike other peers, who have got into domestic formulations and then came to US or regulated markets, or people who have gone from API to formulations, Rubicon's origination remains in R&D and being a science-first company. And if you've seen the return, and R&D is what I would say is as I said, capex we are lagging, but R&D is a lead indicator of our revenues in the future. The kind of work we do on R&D, portfolio selection, and then executing it is, I think, the main growth engine of the company. So we definitely expect the number to be around 10 to 11% of revenue. And we have enough R&D opportunities, or we are very, very excited about our portfolio opportunities which are available, where we are currently spending to build a global pharmaceutical company coming out with innovative products, meeting or solving for unmet patient needs. So I think the number is you should not look at the absolute number, but the opportunities we have, which are fairly significant for the R&D spend we are doing.
I'm going to couple a question here for you, Parag. So two-part. One is with regard to growth, maybe over the next 3 years. What's the kind of growth guidance that you can give us? And second is with regard to your efficiency on working capital. Do your working capital days come off? And if so, do they come off substantially? How much?
Yeah, so Harsh, I'll answer the second question first.
Sure.
The working capital, if you see, there's been improvement from the last year to this year. And I think we have kind of optimized it considering the level which you need in the United States, from sourcing of the raw materials, keeping launch product ready, and then launching the market. So I think from the working capital standpoint, I think we want to guide at where we stand today. We don't want to change anything on that side. Coming to, I think, the revenue guidance, I think you should, and this is there in our investor deck, we talk about the concept of R&D productivity, or, the R&D spend. The lagging R&D spend is an indicator of our future revenues. And if you've seen, that indicator has gone up from around 3x to this current quarter, it has been 5.9x. So just to give you a sense, if you have spent 10 rupees on R&D and then you fast forward it to, because R&D takes time for products to get approved, you take a 20 to 24 months factor, and you see when the first revenues get generated, you see that 1 rupee spend is leading to 5.9 rupees of revenue. So that's the trajectory, or that's the focus as any investor on Rubicon should have, is the kind of R&D we're doing, and we've demonstrated it over multiple years, the quality of our R&D, the quality of our execution. So that is, I think, the way to look at company's growth. So if we, just to give you a sense, we are doing 500 crores worth of R&D in the next couple of years, which is the number if you add up 10 to 11%. And that's the kind of multiplier, I talked about R&D multiplier, can give you a good sense of where we are moving in terms of our revenue growth.
But that's just on new product, right, Parag?
Yes.
The multiplier will just be on the new product. The existing products will also grow.
Yeah.
Got it.
So,
Got it. Point taken. No, very clear. Thank you so much for coming in and detailing that, viewers. So therefore, 2 years ago, whatever R&D was done at 10, 11% of top line, on the new products that come on stream currently, you'll see...
What's the incremental, right?
Yeah, correct. Perfect. Thank you so much, Parag. Thank you for coming in and explaining that. Very interesting way to look at revenues, maybe over the next 2 to 3 years on Rubicon. But completely timed out on this edition of First Trades. Thanks so much, viewers, for joining in. It's a goodbye from myself, Sajid, everyone who puts this show together. Thanks so much for watching.